Welcome to the webinar, What Moves the Yield Curve? Understanding Current Trends and Uncertainty. My name is Michael Eichhorn. I'm a BTRM faculty member, and our faculty is honored and privileged to have Rayce Coyne with us. Before I hand over to Rayce, let me briefly introduce her to you and then explain why I think this is really not only a very topical presentation, but also a very good investment of your time. So Rayce is the CEO of Hedgehog. She's a former CTO of Texas Exchange Bank, and she worked as a derivative strategist at a hedge fund. So she's a practitioner, which I'm sure you value. She holds an MBA from Stanford University, and she started Hedgehog from her dorm room to help banks to get a grip on interest rate risk after the 2023 banking crisis. You may wonder, why did she call her company Hedgehog? And the reason is twofold. First, she wants to help banks to hedge risks, that's obvious. But also the fox and the hedgehog allegory play into this. And maybe as a fun fact, the irony is that while her career has focused on money, her last name is Coyne. Okay, so why am I so confident that this will be a good investment of your time? I think to say that this is a topical presentation would be an understatement in light of what happened over the last days, or should I say weeks. But let me give you 3 reasons. The first one is, I think what you will see is a very practical hands-on guide for navigating today's volatile interest rate environment. The second point is, we believe that in a fast-moving news cycle, an intuitive understanding how market signals translate to your balance sheet is invaluable, an intuitive understanding. And then finally, I'd like to emphasize that while her background is in US banking, the dynamics that we will describe and cover should be relevant globally for each of you on the call. So we are covering the same core challenges, managing risk in uncertain markets. So with this, again, we are privileged and honored to have you here. Rayce, I hand over to you.
Awesome. Thank you so much, Michael, for that awesome introduction. I'm really excited to get to talk to you guys about this today. This is something that is it's very near and dear to my heart. It's what I've spent pretty much my entire career looking at. And, like you said, right, coming from this background of looking at the way that interest rates and all this stuff impacts your balance sheet as on a hedge fund trading desk. And then also, getting to put that into practice at a bank where really, if you boil down so much of what we do, especially the folks on this call, it's an honor to be able to talk to you guys today. This is the stuff that we worry about day in and day out. And I mean it when I say our jobs have never mattered more. It is very important that we get this stuff right. And I think a lot of stuff that we've just kind of taken to be true and kind of been on autopilot for the last, decades or what have you, a lot of those assumptions really no longer apply. So what I'm wanting to give the talk about today is talking about sort of what's different now, what makes today sort of unique, what sort of stuff should we keep in mind, and also make it so that when you see, we're in a really fast news cycle, right? And so when you see this stuff coming across your screen, being able to quickly do a gut check and say, okay, how is this going to affect my balance sheet without pulling out the spreadsheets and the models and doing all of that sort of stuff. So really just let you know where to look first on this stuff and what stuff is top of mind for me and what I've heard from all the bankers that I talk to day in and day out. Yeah, so we're going to be talking about what moves the yield curve. And I think kind of a fun way to start this off is going to be some things that I think people get wrong a lot, right? So one of the big things, and we've been hearing this honestly for a year now, and I don't think it's any truer now than it was a year ago, is just this idea that, okay, well, hey, central banks around the world, they're going to be cutting rates soon. All my problems as a bank are going to go away. All those unrealized losses are going to disappear, all of that sort of stuff. And we're actually going to talk a little bit today about, 1, why that's not necessarily the case, and 2, why rate cuts aren't a reliable protection strategy for your bank. You can't just hope rates are going to come down. You have to plan for what happens if the curve moves in ways you weren't expecting. On that topic, there's the idea that long-term rates are where short-term rates are headed. This can take kind of a couple different flavors, right? You have folks that believe if they just kind of tunnel vision in on managing their balance sheet to the forward curve, that they're going to be just fine. You have people that think that, the yield curve itself as it exists today is basically where short-term rates are going to be in 1 year's time, 5 years' time, 10 years' time. You have folks making these kind of assumptions. And there's a really nice kind of infographic here showing, just how big of a problem that can be, right? Yeah, so we can see in this picture here, right? These are actually futures curves projections versus like what short-term rates actually did over the course of like the last hiking cycle. And, it's a little bit hypnotic to stare at. It's actually, it's a little bit mind-boggling, and there's a lot of data in this graph. But the big takeaway should just be that, forward curves, they turn on a dime, right? As the underlying assumptions change. And a lot of what we're talking about here today is what are these underlying assumptions and how can you know when they've changed? How can you know when the rules of the game are different? And that brings us to our last one here, which is talking about the rules of the game changing is, hey, I bought a couple of swaps. My bank's balance sheet is protected, right? NIM compression's not going to be a problem for us. And that is actually not the case. There's a lot of things that we've kind of held true and held to be self-evident for the last long time that I really just don't think apply as strongly as they used to. And so if you take nothing away, if you slip into a coma and you take in nothing else from this presentation, just remember this slide. These are the 3 really key points that I want you guys to come away with, which is that, rate cuts, they don't always behave the way you expect them to. The long end of the curve doesn't always behave the way you expect it to, and your hedges may not necessarily behave the way that you expect them to, especially if you don't have them set up right and you don't have them really tailored to your balance sheet. So, yield curve 101, let's jump into it. The folks on this call are very smart. Y'all, we have super smart PhD, rocket scientist level people here on this call. So I'm not going to go into the technicals of, okay, how do we bootstrap a yield curve? How do we do all that sort of stuff? But what I do want to talk about is kind of at the big, kind of macro force level, how do we think about the curve? What moves at each end? And what stuff is top of mind for me and for a lot of the bankers that I talk to? And we're specifically going to be focusing on the short end and the long end. We're a little compressed on time, so I'm not going to have time to dive into the mid curve. But for the folks over in the UK, I think there's a lot of interesting stuff happening there right now. And if you want to talk about that, please hit me up offline. I love to talk about this kind of stuff. So let's start with the short end, right? We've all, probably a lot of folks on this call took a finance class in undergrad. We remember or a macroeconomics class, and we remember this idea of there's kind of this market for money that determines the interest rate. This is what we learned. This is what they showed us in the textbooks. And this graph sort of has this downward sloping demand curve for money. We have this finite money supply. And the thing that we learned was that central banks kind of scoot this line left and right, and that is how they set interest rates. Well, it's worth noting that this model was invented a bajillion years ago, right? This was made for a world of finite liquidity. And that is not the world that we live in anymore, right? I think, ever since the great financial crisis, we kind of live in a post-liquidity world where what this means in terms of that graph and that model is that money supply line is all the way to the right, right? It is so far to the right that it has left the graph. It is off the axis. And what that means though is that the market clearing price for money in that model is zero, right? You scoot your supply curve to the right, the price is zero. But we all know that the price of money is not zero, right? We have interest rates are not zero, and interest rates are the price of money. So why is that the case? And what are we using now if we're not using this old textbook model for our economics? Well, we effectively have a price floor for the price of money, and that is effectively interest on reserves. Here in the U.S., where banks park their money at the Fed, and the Fed pays interest on those reserves. Similar setup is pretty much all around the world. This is pretty standard stuff. But I don't think that we're used to thinking about overnight borrowing as these rates that are set by central banks are effectively propping up the floor on the price of money, which would, again, otherwise be zero. If there was no interest on reserves, there would be no money. We no longer have a setup of reserve requirements here. So that's effectively what controls your price to the downside. Central banks also control prices to the upside when you have short-term liquidity shocks where a lot of people need a lot of money really fast. Here in the US, an example that we had, right, was the 2019 repo crisis. I was actually on I was on the trading desk during that time, and I remember this happening and how crazy this was for everybody. But to kind of summarize for everybody on this call who may not be familiar with exactly what happened, there was a need to create a price ceiling because overnight borrowing rates skyrocketed to credit card levels of interest. It was absolutely crazy, and people were panicking. So the Fed effectively flooded the market with extra liquidity, effectively infinite liquidity at a certain rate, the repo rate, and said, hey, this money is going to be available. This creates a ceiling on the market. There's no need to borrow at any price higher than this. And once everybody calmed down, they sucked that liquidity back out of the market because you can't just leave that out there. So they sucked that liquidity back out of the market. Markets sort of regained their senses and everything sort of proceeded normally. So it was effective use of a price ceiling. We're seeing something really interesting right now, I think. And this is another thing where, we have folks on the call today from India. And if you want to talk about this offline after the call, I'd love to connect with you on this. But you have Royal Bank of India is actually doing not the exact same thing, but something similar of, kind of defending this price ceiling through repo operations. They're also pursuing a couple of other strategies as well. And we're really seeing central banks around the world kind of test these experiments in real time and see just how much power they have to control these rates, not just in the overnight, but extending a little further out into the curve as well, and seeing if enforcing this price ceiling, is this something you can do in a sustained way, or is this something that you can only do on a short-term basis? But the long and short of this, and the reason that I go into all of these mechanics, right, is that central banks have pretty tight control over short-term borrowing, and the amount of influence that they have is reflected in just how far out into the yield curve their influence extends, right? It's not just the overnight rate that is strongly dependent on what people think the Fed is going to do or what central banks around the world are going to do. But really, even out to 1 year, 2 year, 3 year, you still see a lot of expectations hypothesis into play. And I think that leads a lot of people to sort of mistakenly assume that the entire curve is expectations hypothesis, right? Which is, not necessarily the case. And you're going to get caught flat-footed if you just think that the yield curve is the future direction of what central banks in your country are going to do. And what does this mean, though, for our balance sheet and for bankers who see these numbers? We see interest rates, we see headlines about interest rates and think about that. But at the end of the day, right, it's no mystery, especially to the folks on this call, that short-term rates drive your cost of funding. And to draw that link a little bit more directly, that means central bank decisions and the problems that central banks worry about are your problems as well, right? Because the things that central banks worry about are going to be what determine your short-term borrowing rates, which are what determine effectively our cost of funding as bankers, right? And modeling this can be a little bit tricky, right? So we're all, some folks on this call, maybe not everybody, is familiar with the idea of deposit betas, where when we're modeling, what effect these interest rate changes are going to have on our borrowing and our cost of funds, we think about betas as this kind of pass-through that says, maybe only half of that rolls through or something like that. But that's not a static number. Those how sensitive depositors are to changes in rates, that is a variable thing. And so it's not really a one and done kind of takeaway. Additionally, something that I've talked to a number of banks that have struggled with this is this idea of duration rotation. So this may not be a term that folks here have heard before, but it is something that a lot of people that I've talked to about, they think about this and they're worried about it. So over the last, few years, we've been in this high interest rate environment, right? Rates have been higher and people notice this, right? Depositors watch the news. Depositors are savvy. They know what to do with their money. And so banks, all around the world have seen people rotating from these zero interest checking accounts into either savings accounts or in some cases rolling into CDs as well to really try to lock in those higher rates because why would you not want to do that, right? But this presents a unique modeling challenge to us as ALM professionals, right? Because if you have we model deposit flight scenarios. This is something that if you model bank balance sheets and you think about this kind of risk, you probably think about deposit flight cases. We remember SVB, right? This lives permanently in our memory. But what we may not necessarily have a good way to model or think about is this duration rotation of people rotating out of these low duration, low rate accounts into higher duration, high rate accounts. And these funds didn't leave the bank. They didn't go anywhere else. They're still at your institution, but they're in they're now in an instrument that has a very different interest rate profile and a very different interest rate risk. And so again, the same assumptions that we've been using before the hiking cycle, before all of this stuff started, may not necessarily apply. And it's worth kind of thinking about, okay, if we're going to model rates going up and what that's going to do to our institution, it's maybe worth thinking about, okay, we adjust our prepayment, right? We adjust that sort of stuff. Well, how do we adjust our depositors' behavior? How do we adjust for this duration rotation? How do we include all of this stuff in our modeling? And if that's not something that you're including, it may be worth taking a second look at that. We're not going to go into the details of the mid curve because, again, there's just too much to talk about. Um, but at the long end, the big thing that I want to like kind of highlight here, right, is that the long end does not necessarily, for the reasons that we've been describing, right, the long end does not have to move the same way as the short end, right? Rates coming down does not mean that the long term yields are going to come down as well. It may, and that may happen. But some things are worth taking a look at here, right? So this is, and again, this is a global phenomenon, but every economy is a little bit different. Um, we've been seeing kind of a creep up in this term premium. This graph that I have on here, right, is showing this is, again, this is from the US side. This is the term premium on the 10-year zero coupon bond. And what we generally see, right, is we see decades of that line generally moving down, right? Since COVID, though, we see that line generally moving higher, right? And an increase in the term premium on these zero coupon bonds generally that is a steepening effect. That means that as you go further out into the curve, the risk premium that you have to pay for going further out into time is getting higher and higher. And what this is turning into is sort of this idea of term premium creep, right? And what I mean by that is you have the long end of the curve, kind of even as central banks are cutting rates and making short-term rates lower, you have this long end of the curve where rates are actually going higher. And this is a problem for us as ALM people, right? Because long-term rates going up, these are the rates that we're using when we're discounting our long duration fixed rate kind of assets, right? And so it seems kind of counterintuitive and, maybe to some folks on here, maybe that sounds kind of obvious, but maybe some folks are hearing this for the first time, that you can actually have central banks cutting rates and still be seeing effectively a rate hike at the long end of the curve. And that's going to affect your economic value of equity. That's going to affect your model outputs. That's going to affect all of this stuff. And it's worth keeping in mind that short-term and long-term rates don't have to move in lockstep. And I just want to make sure that people don't make that mistake when modeling their things. And this is something I've talked to folks from, some of the local Federal Reserve chapters. I've talked to regulators about this, and this is a very real concern for the people that are making these policies and the people that think about this day in and day out. Again, all around the world, right? If you have this term premium creeping up on, whether it's geopolitical risks, whether it's inflation uncertainty, whether it's growth uncertainty, any of these sort of things that can potentially drive your term premium up, well, that's going to affect our balance sheets as banks at the end of the day, right? This is just as much as a concern for world governments as it is for us. And so I want to kind of tie a bow on. I've thrown a lot of stuff at you, but I want to really bring all of this into what are some big takeaways for things that we should be looking out for, things that we should be thinking about. At the short end of the curve, sticky inflation is a big deal, right? This is something that we're still seeing in a lot of countries. We do see petering inflation in parts of Europe, but at least here in the US, and that it is every headline's about inflation, right? And this is the case in a lot of countries. And in a world where inflation stays sticky, even if it's cost push inflation, even if it's because of, whether it's trade disruption, shipping disruption, or just systemic, things that make things harder to get or whatever, if inflation stays high, there's no indication that central banks are going to be, gung-ho to cut rates. And that's something to think about. At the same time, fast cuts can also kind of lead to some unintended consequences as well, right? Because we remember from our slide earlier, right, these short-term rates, they not only control the cost of our funding, they control the economic value of our funding as well. So something that I kind of want to, maybe just throw out for you to consider, right, is this idea of, okay, well, let's say short-term rates go down, long-term rates stay high, right, or something like that. Well, when the short-term rates come down, the discount rate on some of your liabilities, you can actually see that go up, right? And the economic value of your liabilities going up, that has a negative effect on your economic value of equity that you hope, fingers crossed, is offset by an increase in the economic value of your assets. So that's, of course, not guaranteed. Just worth thinking about, especially if you had duration rotation. At the middle part of the curve, it's really just, and again, we didn't get to dive into this the way that I wanted to, but the middle curve is all about this duration appetite. And appetite for going into the middle of the curve is where you see a lot of carry trades happen. And it's really a referendum on central bank credibility to actually like steer short-term rates to where long-term rates think growth and inflation, all of that stuff is heading. This has implications for your net interest margin, economic value, all of that. And those are not guaranteed to move in the same direction. At the long end, I said it before, I'll say it again, I'm going to repeat it, keep an eye on term premium creep. And I want to really hammer home what this could look like for bank balance sheets and something that, it's maybe worth thinking about and worth preparing for, right? So there's this idea, right? Like, what would a duration crisis look like? Like, what is this? Um, and the way that I think about this would be, okay, we have this term premium creep at the long end of the curve, right? We have maybe cuts on the short end because we see okay, cool, inflation's going down, or oh no, unemployment's going up, that sort of stuff. Um, how can this actually be a bad thing? How could rates cuts possibly be bad? Well, if long-term rates continue to move up, right, that takes the economic value of your assets down, right? This is basic bond math, kind of the idea of, okay, long-term rates go up, economic value of assets go down. Well, if at the same time you have short-term rates going down, that means that the economic value of your liabilities is going to go up. And both of these things are quite bad for your economic value of equity. So you can have almost this effectively like a double squeeze on the economic value of equity for your institution. And if this is not something that you're specifically hedging against, like this kind of specific scenario, then you can really get caught sort of flat-footed on this. And hedging against this is not necessarily intuitive, right? Something kind of worth thinking about is like I've talked to a lot of banks that say, either like I've heard folks say like, hey, my balance sheet hedges itself. I hear that sometimes. I hear folks say, hey, we bought a couple of swaps, we're all good. I hear folks say interest rate risk doesn't apply to me. That's its own case. But I don't think that the old playbook of, hey, we're just going to protect our NIM, we're going to pay float, receive fixed, this is great. I don't think that that works in this kind of duration crisis idea that I painted. I'm not saying that's where we're heading, but if that does happen, this strategy does not necessarily offer you, I think, the protection a lot of folks think that it does. And the reason I say that is like, okay, cool, you've protected your net interest margin on one side, yeah, but you still are going to have all of these unrealized losses on your long-term assets, and like, we've seen where that can go, right? We've seen over the last few years what can happen with that. And so the question becomes, okay, like, fine, lady, my swaps don't work. What do I do, right? Like, what could this look like? And I'm not here to, tell you how to hedge your institution. Everybody's balance sheets here are different. But a couple of ways to think about this, and maybe some kind of less talked about ways that I think actually like tackle the problem directly, are one, I've talked to a couple of banks that are using like swaptions and collars and rate caps and floors to actually hedge like volatility itself, right? So you're not hedging the direction of rates, you're hedging volatility in rates, which is that's kind of the thing now, right? Like rates are really volatile in a way that they haven't been for decades previously. And if people are still behaving in a way like interest rates are stable when interest rates are not stable, they can get caught flat-footed. The other thing, and I've seen a few institutions doing this as well, is actually hedging relative moves in rates. So these are curve hedges. You can either set up a steepener swap, or you can set up a steepener swaption that takes two durations on the curve. So maybe let's say 2-year, 10-year, or something like that. And you can actually you can hedge your bank's balance sheet against like moves in those rates. That's a complex process. It's a little tricky to do. But like make sure that you have good modeling and stuff in place to do that. Because with all of these, right, regardless of whether you're doing swaptions or curve hedges, or even just like a really well organized swap or futures portfolio, the most important thing, right, is that you are able to like try before you buy on these things. Make sure that you have modeling in place at your institution that can like actually like say like, okay, what is this swap going to look like on my balance sheet? Like, how much of this swap should I buy? Like, how much of if we're, especially if you're going to be dealing with really complex things like swaptions that have these like nonlinear payoff structures, that can be really intimidating to approach for the first time. And it's just, it's worth thinking about, like, especially if, a lot of banks don't necessarily have someone at the hand who's worked with these before. So just make sure that you work with trusted folks on that. Honestly, like that's kind of that's my core thesis on this. I think we can move at this point to kind of some like questions and answers and stuff. Yeah, I saw a question actually come up in chat, of someone kind of asking about this duration rotation, right? Which again, I wanna be totally honest about this. It's effectively like it's a term that we made up, but there's not really a good word for this, I think, otherwise. Maybe you could call it migration, but duration rotation is really the term that, has seemed to stick. And this idea is, like, to kind of explain this another way, right, is it's people moving like people are still your depositors are still customers of your institution. The money is staying on your balance sheet, right? On the liability side of your balance sheet, but it's moving into a different kind of account. So this is saying things that are moving out of checking account into savings or moving out of savings into CDs. And I mean, that's what you would see in like an increasing rate scenario, right? You can see this rates are higher. So why would I accept 0% interest on my deposits when I could receive more in a savings account or even more by locking in a CD or something like that? And that fundamentally changes the duration profile of your borrowing. And that's going to have big effects when it comes to not only your like net interest margin, right, in forecasted scenarios, but that's also going to affect your economic value of equity. And it's just something that's worth thinking about. And what we maybe haven't seen, and maybe this is something where again, if you have hard opinions on this, please reach out to me afterwards. I want to talk about this. But okay, in a world where rates move down, what does that duration rotation look like? Do people just sort of magically flow out of savings accounts back into checking, or do they kind of stay there? Is that like at what point do people gravitate back to checking accounts? Because we know for years people love checking accounts. At what point do they start going back to that, and what causes that? What causes people to no longer renew their CDs and maybe go from CDs? Do they go into savings? Do they go into checking? This is something that's going to be different for like every institution. It really comes from understanding your borrowers' behaviors and what they're doing.
Thank you, Rayce. I've got actually lots of further questions. So maybe I go with the next one. That's from Tomi. How would you hedge against the double squeeze structural hedge program? Would you use the structural hedge program, I assume?
Yeah, so for the double squeeze, that really is a tricky one, right? And it's one where just hedging like one part of your portfolio doesn't like that doesn't solve the problem, right? And I've talked to a bunch of different banks that have a bunch of different like hedge schemes set up, right? A bunch of different structures for this. Um, and like to be honest, like yeah, just the check the box fixed floating, like that kind of setup, like that doesn't protect you in this for basically exactly the reasons that we talked about, right? Um, and that's why, like, really making sure that you hedge, like, both parts of the curve, and there's a number of ways to do this, right? It's not just a steepener swap, like, it's not just the 2-year, 10-year, pay or receive kinda setup, like, it's not just that. Um, but it's also, like, you can use, like, other kind of dynamic strategies, and then, like I said as well, if your real concern about this is, like, you want this optionality, you don't wanna lock in a specific cash flow, but you want to be able to say, okay, like if something like really crazy happens and we do have this like massive surge in yields in some part of the curve, what is that like? I want to be protected against that thing specifically. If you have that really specific threat in mind, then that's kind of where like swaptions and stuff like that can come in because you're effectively making a narrower bet with your hedge, but you have a little bit more optionality in that in a way that some institutions may find desirable.
Thank you, Rayce. I get plenty of questions. So the next one, and hopefully we get through most of them, is given the inherent challenges in forecasting the yield curve, what do you think is the most underappreciated variable or model limitation that forecasters should pay more attention to?
Ooh, most
I
important
had a similar
limitation.
question before.
Yeah.
I also had a question, what is the most underrated data point our
Ooh,
listeners should be watching,
the most
or that
underrated
doesn't show
data.
up in the headlines?
I like this. Okay, kinda like giving out like a trophy there. I well, these are closely related. So, I think on one hand, like, something like a big takeaway from all of this really should be that just looking at the yield curve, like, the yield curve is not a crystal ball. I've talked to people that kind of like there's a lot of ways that we can kind of back into that. People say, "Oh, the 2-year, 10-year spread or the spread between this part and this part of the curve. This tells you that we're headed to economic ruin. This tells you that this is gonna happen. This tells you that that" not necessarily the case, right? I like, obviously, like, history happens and stuff like that. Um, but the curve itself, like, can be interpreted so many ways, right? Like, I mean, we just had an example like this week in Germany, right? Like, if you have a surge in long-term yields, uh, there's kind of this fundamental question there of, okay, is the curve steepening because we're foreseeing all of this beautiful, bountiful economic growth that we love? This is a good sign, Or is that term premium, or the basically, like, effectively the steepness of the curve, the rate at which people demand to be compensated for time passing, is that creeping up because, for example, like, do we doubt that the government's gonna, like, pay its money back? You have, like, those kind of concerns, right? So both of those can lead to the similar movements in the curve, and so it's important, I think, to be kind of holistic in what you're thinking about with this, right? So, for example, like, to go back to the question of most underrated data point, if you want a takeaway from this that says, like, hey, here's something that they probably don't talk about a lot in news headlines that maybe you should think about. Look at government bond auctions. Take a look at that. Government bond auctions, like, that data is generally free online. You can Google it, you can download it, and you can track it over time. And the reason that I say that that's maybe a kind of a cool, kind of out of the pocket data point to look at, right, is that if you see lower performance in government bond auctions, you see less participation, you see less demand, you see a fallout in, like, the bid to cover ratio, you see kind of these just generally, and I recommend Googling all these terms, like, learn a little bit about this. If you see a weakening in demand in government bond markets, that can be kind of an early sign that maybe this duration crisis scenario, which again, totally hypothetical, but, like, if this could be a sign that that may be the direction that we're moving in, because weaker bond auction data, that can push yields up, that can cause the long end of the curve to really move against the short end in a way that's going to affect all of our balance sheets.
Thank you, Rayce. I get more questions. The next one is first from Jill. She's congratulating you to a great presentation, which I
Thank
totally
you.
concur with. She's asking, how do you see the challenges in qualifying this type of asymmetric strategies for hedge accounting under US GAAP? So the economic versus accounting implications.
Ooh, talking about, like, the economic implications of, like, for example, if you're putting on some of these, like, swaps, like, how do you do the accounting for that? Or sorry, I'm not sure that I understand the question.
Yeah, I think that there's this accounting implication. So I think it's one thing to implement these hedges to protect yourself in an economic way, either protect the net present value of your book, but it's something else to factor in all these different accounting treatments, and I think that's where the question is targeted at.
That's a really good question. I don't know the full, like, accounting implications of some of these, just to be totally transparent with everybody. But I think, like, this is one, like, if you do actually consider, like, putting these on, make sure that you research that ahead of time. There are folks that know a lot about, like, how that stuff is actually going to get treated on your balance sheet, and there's nothing saying that, for example, like, the payout from, like, a swap option or something like that is going to be accounted for the same way it would with, like, a plain vanilla swap. So I think it would kind of depend also on your, like, your country and stuff.
Yeah, I agree. I've even seen it in one and the same bank that the strategies enjoy different accounting treatment. So as you say, should be agreed beforehand. The next question is related to NII and EBE. So what do you hedge preferably, NII or EBE? And then
Ooh, what a
sometimes they
question,
are
right?
opposite sensitivities.
Yeah,
Yeah,
no, that's I love that you asked this question. Because that's kind of what this comes down to, right? Is like, that you don't necessarily hedge them both the same way, and that you can have problems, like, on one side that, like, may go the other way on the other. Um, this is I think there's been a little bit of a bias in a lot of the institutions that I talk to that really only look at NII. And I think maybe part of the reason for that is that EVE really is, like, it's kind of a complex contract, right? It's a bunch of discounted cash flow, it's a bunch of present values. There's a ton of assumptions put into that, whether you're looking at, not just, like, prepayment, discount rates, sensitivities, like, you have all of these assumptions being put into economic value of equity. And to track your institution based on that, like, that's kind of a hard sell for people, right? To say, hey, this number is such a construct, it's so theoretical. Like, why should I bother hedging this, right? And do I think that you should, like, hedge your economic value of equity to really target some specific outcome in, like, a plus 200 scenario or in, like, a ramp scenario or something like that? No, that sounds a little bit hard, sounds a little bit theoretical, and you're going to run into in fact, the exact thing that you described, right? Which is that, like, okay, well, if you get so busy hedging that, then maybe your net interest margin doesn't move the way that you want it to. And that's going to have a direct result on, like, on your bank's bottom line. That's going to really affect, like, the CEO of your bank is going to have a really strong opinion on that, right? Um, but I think at the same time, it's worth thinking, okay, and if we zoom out to the highest, like, to the highest ballpark level, right? If we, thinking back to that slide where it's literally just, like, up arrows and down arrows, right? What is the threat in a duration crisis scenario? What is the threat to economic value of equity? Let's break that apart. Let's look at economic value of assets, economic value of liabilities. This is a decision for us as, as bankers and folks in the treasury profession to think about, okay, what is more sensitive, the economic value of my assets or the economic value of my liabilities? Model that out, right? And more importantly, be able to see what happens if you're wrong, right? Because if you you make assumptions about your deposit portfolio, your deposit betas, how sensitive they're going to be, what the run rate on your deposits are going to look like. We make assumptions about all of these things. But how often how often do we test them? How often do you see, okay, what if I was just wrong? What if our deposit study came to the wrong conclusion? What if this happened, right? Then the economic value sensitivity of your liabilities can be totally different than you were modeling for. And just being able to recognize when that's starting to happen, that this will show up in back testing, this will show up everywhere. Um, but I think that's kind of something to keep in mind.
It just illustrates how critical it is to have a risk appetite for both for EV and NII. And then as you say, depending on the risk preferences,
Right.
this risk appetite maybe
It depends on
calibrated
where your
differently. But they
sensitivity
should,
is.
exactly, and they should be tested.
Yes.
I think. So I've got the next question that's related to the trading and banking book. How would you balance hedging the banking book with instruments in the trading book without generating counterproductive accounting asymmetries? You've got any views on this?
Yeah. So
How?
at the highest level, what I kind of interpret this as is sort of the question of hedges are great and we love having protection if things go really wrong, right? But at the same time, hedges can be kind of expensive. And especially if you're putting on those hedges in a time when rates are already volatile, right? The implied volatility on some of these things, like the implied volatility on swaptions or something, for example, may already be kind of high depending on what country you're in. Um, and you can have hedges work in a way that you don't necessarily want them to, where, for example, if you decide you see this and your takeaway was, oh my gosh, I need to hedge interest rate volatility. Okay, I'm going to go out and buy a bunch of swaptions. Great. Well, y'all have seen the news. There's a lot happening in the world right now. And there's a chance that when you're buying these swaptions and stuff like that, you're actually buying with a pretty high implied volatility, right? It's reality is worth looking into. But if you buy those and then suddenly everybody calms down tomorrow and everything goes just fine, well, okay, the value of those swaptions can go down. There's less implied volatility. Um, and suddenly you're paying money for a thing and now you're paying even more money for a thing for a situation that may not even seem like it's in the cards anymore, right? And I'm not saying this to say don't go out and buy swaptions today. But it's worth really looking into okay, how are these things actually priced and what are they going to do on my balance sheet if rates do X, if rates do Y, if rates do Z. And I think that's why it's important to really be able to, like I said, try before you buy. Make sure that when you're looking at this stuff, you don't just run it in a model in isolation. You really make it a part of your ALM process, right? Be able to see, okay, so cool. We're modeling some duration rotation. We're modeling for a world where we have a bear steepener or a super bear steepener or something like that happen. What do these new derivatives that I'm considering adding to my balance sheet, what did they do? How did they perform? Did they do what I wanted them to? Or is the price just not right?
Rayce, the next question is related to interest rate futures. We've talked a lot about swaps, and I think it's Luke who is asking, what is preventing the wide-scale adoption of interest rate futures within banks' ALM, at least in markets dominated by short-term fixed? Do you've got a view on that?
Yeah, I mean, I think in some ways, and again, I don't know if this is the definitive answer on this or not, but I think some of it just comes down to comfort, right? Swaps really are a go-to for a lot of the institutions that I talk to. That's been the playbook for a really long time. That's what they're comfortable with. Yeah, futures are traded on an exchange. It's maybe a little bit more liquid. I've talked to there's folks that create simulated futures, right? That are actually these exchange tradable instruments. The folks like Eris Futures, the stuff that they've built is really incredible. And this isn't necessarily a commercial placement for them, but they have some really smart people trying to solve this problem. And at the end of the day, I think the big obstacle to adoption on this, there's a ton of ways, swaptions, steepener swaps, all of these kind of unconventional ways of hedging a bank balance sheet. you're gonna run up against inertia, right? And I think if your goal is to overcome that inertia at your institution and maybe if you're looking to persuade a board of directors and show them, hey, futures aren't scary. Futures may actually make a lot of sense for us specifically for the following reasons. Here's some prices. Here's what it would cost us to actually put these on our balance sheet. And at the end of the day, being able to show your board of directors, look, in dollars and cents, this is what it costs us to put it on. These are some of the most likely scenarios that we think rates are going to do, and this is why it makes sense to have these on our balance sheet. I think if you can phrase things in those terms, it really helps kind of make that sale and overcome that maybe unwillingness to try something new.
The next one is, maybe I take this one first from a guest viewer. How do you expect upcoming Fed rate decisions to shape the curve? And how do you see the US Treasury yield curve evolving over the next 12 to 24 months?
Ooh, that's a good well, okay. So I mean, just to kind of level set on that, if I had a definite answer to this, I would not be like here on this call necessarily right now. I'd be out there like trading a bunch of bonds and stuff like that, right? But I do think there's some stuff here to look for, right? Um, and when it comes to short-term rates, right, people have penciled in like a number of like Fed rate cuts. People have like if you look at forward curves, you look at futures curves, people are expecting those rates to come down, right? This is again not just the Fed. This is kind of generally all around the world. Um, but I mean, I would caution people on this. I was in December of last year, right? If you looked at the rate cuts that people were predicting were going to happen in 2024, they missed the mark completely. They were expecting all of these really aggressive cuts, but hey, you know what? Turns out there was still inflation. The cuts didn't happen. And I think there's been pretty strong signaling by central banks of saying, hey, rates aren't coming down till we see inflation start to back off. And you have seen that in, like I said, in parts of Europe or something like that. But at least, you asked specifically about the Fed. Here in the US, that's not guaranteed to go away, right? And especially if you do have this really sticky kind of cost push inflation keeping prices higher, if you have the example that I used earlier was like if you have like trade disruptions, right? If you have like just any sort of things that can happen that may keep prices like higher than they otherwise would be, well, that's going to make it really hard for the Fed, they've been very direct about this, right? Inflation doesn't come down, rates don't come down, rates can stay high. If you start to see like the other part of the dual mandate really become a problem, if you have like a spike in unemployment, maybe that changes the picture. But otherwise, like I would be very careful about like betting on a lot of aggressive rate cuts. And then, like I said before, also making sure that when you are predicting those rate cuts or when you are seeing what those rate cuts are going to do for your institution, um, you don't just make the mental shortcut of saying, oh, it's going to fix my problems. Rates come down, rates meaning the entire curve come down, we're going to be great. That's not necessarily the case.
And then raise the next question. I think you have hit a nerve with regard to duration rotation. So it's also related to duration rotation from Toomey. And the question is, what are the other considerations one should look at before employing duration rotation, hedging other than the intuitive migration of deposits of the bank? And then the question is asked because at the peak of the COVID-19 crisis, at least in our domestic market, the central bank dropped rates. However, the duration on deposits stayed long. So there was not notable migration. That's how I understand the question.
Right. So that's kind of exactly the thing that I like think about a lot. And again, I may not understand your question fully, and if I did, please let's make this a dialogue. We can also talk about it more offline. But I think like that's kind of the concern, right? Is that like one, depositors at institutions are going to behave differently. So I don't think just kind of saying our depositors are going to behave like some sort of like peer group industry average. I don't think that that's necessarily a good way to set those assumptions for your model. But like more directly, right? So let's say that you do have, like in this case, if I'm not sure if I understood this right, you said our depositors were already kind of like high duration sort of deposits and that rates came down and they didn't rotate out of those into checking. Okay, cool. Like
Exactly.
that's kind of how this behaves. Well, I mean, I'd be curious to see like actually like look with you like at like how that affects your economic value of equity, because I think a lot of banks, and specifically like I've talked to a number of banks here in the US that are kind of in this exact situation where they do have these accounts that are locked in at this kind of higher duration. If rates get cut, people don't migrate out of that. Okay, well, we can do the bond math in our heads, right? Okay, the discount rate on these deposits has gone down. The coupon rate staying the same, that means your economic value is going to go up on your liabilities. That is generally bad for your economic value of equity. And maybe there's a world where the other assumptions that are going into your model, like mitigate that. Maybe it's not a very big portion of your deposit portfolio that's in these high duration deposits. I don't know your balance sheet. But if that sort of thing happens, and if that happens like at a big scale, that can actually be quite bad for a bank in kind of the same way that a rate hike, sort of did in SVB by taking down the economic value of assets. It just happens from the other side of the balance sheet.
Thank you, Rayce. I think we've got one more question, and I got a question already prior to the webinar that I want to close out with. And I would be interested in your view, what makes this rate environment so different from classic hiking, cutting cycles of the past? So what is different this time,
Yeah,
in your view?
that's a good question. So, since this is the last question, I kind of we can use this as kind of an opportunity to like bring stuff home, right? I think the big thing that makes this rate environment different is that like if we're being really honest about this, right? We have a lot of really smart people thinking about this stuff day in and day out, but we are in uncharted territory. This is new for us, right? Um, and I think what that means is that like after like we've had years of low rates, years of QE, that's starting to change. You have central banks that are trying to like reduce the size of their balance sheets. That's a little bit different. That has implications for liquidity, for kind of like all the reasons that we talked about earlier, right? Um, I also think that we're still kind of living in the long shadow of like the great financial crisis, right? And there's a lot of things that we've just sort of taken over like the last decade and a half or so to just kind of like it's just part of like market distortions, right? We have all of this excess liquidity in the system. We have these big asset bubbles. We have like this like debt dependency by all of these like really big governments and stuff like that. Um, like what happens to that going forward in a world where we slowly start kind of like pulling the Jenga blocks like out of the tower, right? And lastly, I think the other thing that I would point out is that you have, I don't know, just to kind of roll back the clock a little bit, right? Like if we roll back the clock to 2002 or even like 2012 or something like years and years ago, there was kind of this idea that like the uncertainty was growth. We knew what inflation was going to do; it was going to do nothing. Um, but it was like how quickly are we going to grow? That was kind of this fundamental question, and markets generally worked that way for a really long time. And that's not necessarily the case anymore because inflation's actually highly uncertain right now. It depends on international relations. It depends on, like heck, if bird flu becomes a problem, okay, well that's going to affect inflation. You have all of these like competing forces. You have governments doing stimulative fiscal policy at the same time that they're doing stimulative monetary policy. You have all of these things are going to affect inflation. And if you just looking at markets, like there is uncertainty about what inflation either globally or within like specific countries is going to do. And in a world where you have pretty predictable growth, which is to say low, a world where you have predictable growth and unpredictable inflation, that breaks so many models that we just kind of take for granted, right? Like that actually messes with a lot of things. One example that I would give, this is actually kind of a fun one, is this idea of, like if we like just think about like retail portfolios, right? Like people placing their stocks in places. People were told for decades that you do a 60-40 portfolio and your money's going to be safe, right? People, that was this rule of thumb that emerged from somewhere. You have 60% in equities, 40% in bonds, whatever, you're going to be fine, because there was this idea that they're going to be inversely correlated. And that was just kind of taken by, and it still is taken by a lot of people to just be an immutable fact of nature. Well, that only, like, if you really dive into the math of how, like, where that number comes from, like, where that correlation between bonds and stocks, where all of that comes from, it really does kind of make this assumption that inflation is predictable and that growth is like kind of the variable that we're solving for. In a world where that's flipped, like that's part of why like people have been, I think, so flummoxed in there. Like, why are stocks and bonds moving in the same direction? Well, it's because the underlying assumptions of why they were expected to move in different directions, if those assumptions no longer apply, then your model no longer applies. And I hope that everyone's kind of takeaway from this is not, I should go out and buy a bunch of swaptions. That's not what I'm saying. I don't think that everybody's takeaway should be, I'm going to go out and buy a whole bunch of swaps. That's not what I'm saying. Or like, I need to completely change my ALM modeling. That's not what I'm here to say. The main message that I want you to take away from all of this is that it's worth thinking about headlines in terms of how does this change my fundamental assumptions that I'm using to manage my portfolio, to manage my bank, and to think about my levels of risk. And if those assumptions turn out to no longer be true, okay, then let's go back to the drawing board and see what that implies for everything else.
Thank you. That's fantastic. And I think at that point, I would close the discussion. Before we part. Great, Rayce. I want, on behalf of the entire BTRM faculty, thank you again for sharing your insights, for sharing your original insights. I know this setting was new to you, but I think the quality and the number of the questions, the number and the quality of the questions from our listeners speaks volume, that this was a good investment of their time. And I appreciate all the work you have put into this. So thank you on behalf of the entire faculty. Thank you for making this so interactive and asking lots of very insightful questions. And I'm grateful for all the work done. Thank you. If there are no further questions, I would close this webinar, and I hope you enjoyed it. Thank you.
Awesome. Thank you so much, everybody, for coming. And yes, please don't be a stranger. Reach out to me. I'd love to hear from you and talk about this more.